At 3 o'clock in the afternoon of Saturday, November 8, 1890, a senior partner of Baring Brothers walked into the offices of the Bank of England at Threadneedle Street in London and delivered a document that would change the history of global finance. The document was a balance sheet. What it showed was this: Baring Brothers, the firm that had been called the sixth great power of Europe, ranked alongside England, France, Prussia, Austria, and Russia, was insolvent. Baring Brothers had £4 million in capital and £15.7 million in liabilities. It held £8.3 million in Argentine securities that no buyer would touch. The firm had been quietly borrowing around the market for months to finance a portfolio it could not sell, and by the first week of November 1890, the borrowing had run out. Without intervention, Baring Brothers would not open on Monday morning. The man who received that balance sheet was William Lidderdale, governor of the Bank of England. He had held the position for 2 years. He was 53 years old, and he had 72 hours to decide whether the British financial system would survive the week. What Lidderdale understood immediately, and what the public would not know for 7 more days, was the true scale of what he was looking at. Baring Brothers was not simply a large bank. It was the infrastructure of global trade. The firm financed wheat shipments from Argentina to Britain, cotton exports from America to Europe, government bonds from 6 continents. If Barings collapsed on Monday morning, the letters of credit it had issued across the world would become worthless paper, ships carrying grain would sit in harbor, merchants waiting on payment would receive nothing. The international trading system built over a century would freeze at its most critical node. The balance sheet on Lidderdale's desk was not just a bank's problem, it was the world's problem. To understand why the failure of one bank could starve global trade, you have to understand what Baring Brothers actually was. The firm had been founded in 1762 by Francis Baring, the son of a German wool merchant who had arrived in England with nothing. By the time Francis died in 1810, Baring Brothers had financed the United States government's purchase of the Louisiana Territory from Napoleon, one of the largest real estate transactions in history. The French statesman Talleyrand had described Barings as the sixth great power of Europe, and the description was not hyperbole. By 1890, Baring Brothers had offices on every populated continent, relationships with every major sovereign government, and a reputation for absolute financial soundness built over 4 generations. That reputation was what made the Argentine opportunity so tempting. Between 1885 and 1890, Argentina was the fastest-growing economy in the world. Foreign capital was flooding into the country, new railroads were being built, land prices were rising, the government was ambitious and willing to borrow, and Baring Brothers, as Argentina's primary international banker, channeled an estimated £140 million of investment into the country over 5 years. That figure represented one of the largest concentrations of foreign capital in any single emerging market economy in the entire 19th century. The mechanism was straightforward. Barings would sell Argentine government bonds to British investors, take a fee, and pass the proceeds to Buenos Aires. When demand for the bonds was strong, everything worked. When demand weakened, Barings was left holding unsold bonds on its own balance sheet. By mid-1889, demand had already started to slow. Barings kept selling. By late 1890, the firm was sitting on a pile of Argentine paper that the market had entirely abandoned. Before we go further, if this kind of history matters to you, consider subscribing to the channel. Every video here is built around the financial decisions that actually changed the world. The crises, the policy failures, the moments when the system revealed what it was designed to protect. If that is the kind of analysis you want to keep watching, the subscribe button is how you tell us. And we want to hear from you. Did you live through one of these turning points? The 2008 collapse? The 70s oil shock? The end of Bretton Woods? Did it change your family's circumstances, your understanding of how money actually works? Leave it in the comments. The most complete record of these events is not in any official report. It is in the people who were paying attention. Now, back to the account. Argentina's boom of the 1880s had the structure of every speculative cycle that has ever ended in collapse. The ingredients were always the same: low interest rates in the lending country, an ambitious government in the borrowing country, an infrastructure story that made every loan seem obviously productive, and a growing crowd of investors who did not want to miss the opportunity. Argentina's monetary base had been growing at an annual rate of 18% since 1884. Inflation was averaging 17% a year. The paper peso had been depreciating steadily against gold, yet foreign capital kept flowing in. because the returns on Argentine bonds remained higher than what London could offer, and because Baring Brothers, whose name on a prospectus was as good as a government guarantee, kept bringing new issues to market. The break came in July 1890. A popular uprising known as the Revolución del Parque forced the resignation of President Miguel Juárez Celman. The new government inherited a public debt that amounted to 40% of the previous year's entire fiscal revenue. The interest payments alone could not be met. Argentina was effectively in default. In London, the Argentine bonds that Baring Brothers had been unable to place with investors and had been holding on its own account while borrowing short-term money to cover the positions were now worth nothing. The news from Buenos Aires had removed the last possibility of finding buyers. Barings was caught with £8.3 million in toxic assets and £15.7 million in short-term liabilities that were coming due. It was not the first time an emerging market boom had destroyed a major creditor. It would not be the last. But the particular catastrophe of November 1890 was that the creditor at risk was not simply a large bank. It was the institution through which the entire Victorian global trading system settled its accounts. William Lidderdale had received the Baring Brothers balance sheet on Saturday afternoon. By Sunday morning, he understood that he had one option. He could not let the firm fail. The Bank of England's own gold reserves were uncomfortably low. A banking panic, which would begin the moment Barings failed to open its doors, would trigger a run on every major London institution as depositors and creditors tried to extract their money simultaneously. The Bank of England might not be able to hold the line. Lidderdale was facing not just the failure of one firm, but the potential collapse of the entire Victorian financial system. What Lidderdale did next was methodical. He contacted the major London banks one by one in secret and told each of them what he knew. The message was simple. Barings was insolvent. The Bank of England would organize a rescue, and every institution that participated in the rescue fund would be protected. Every institution that did not participate would be on its own when the panic began. He also contacted the central banks of France and Russia. Both agreed to provide gold in exchange for British government securities, effectively lending the Bank of England the international reserves it needed to defend sterling while the domestic rescue was organized. The secrecy was total. The City of London went about its normal business on Monday, November 10th, completely unaware that the rescue of Barings was being assembled in private meetings across the square mile. Not a single word appeared in any newspaper. Not a single rumor reached the trading floors. Lidderdale had organized what modern regulators would call a systemic rescue, the first of its kind in history, and had done it in complete silence. On Saturday, November 15, exactly 1 week after receiving the balance sheet, Lidderdale announced the rescue publicly. A guarantee fund of £17.1 million had been assembled. The Bank of England had provided a direct advance of £7.5 million. The crisis that should have destroyed the Victorian financial system was announced as already resolved. The Investor's Monthly Manual wrote after the rescue, "The past month will long be remembered in the city. The downfall of Messrs. Baring Brothers, perhaps the greatest firm of merchant bankers in the world, would alone have sufficed to keep it in remembrance. But it will be even more distinguished by the fact that a crisis of the gravest character has been averted by the action of the Bank of England." The structure of the rescue was as significant as the rescue itself. Baring Brothers was not simply bailed out and allowed to continue as before. Lidderdale demanded accountability. The Baring partners were required to sign over powers of attorney over their personal property, their fortunes, their estates, their assets, as unlimited liability partners covering any losses from the liquidation. The old firm was divided into two parts. A new company, Baring Brothers and Company Limited, took over the profitable trade finance business. A separate entity retained the toxic Argentine assets and was managed by the Bank of England. It was, in the language of 2008, a bad bank structure. The good assets were ring-fenced. The toxic assets were isolated and managed down. The partners bore personal losses. No public funds were at risk. Nathan Rothschild, head of the firm that was Baring's only true institutional rival, said after the rescue that if it had not happened, perhaps the entire private banking system of London would have collapsed, which would have caused an economic catastrophe. Queen Victoria, in the 53rd year of her reign, wrote about the Barings crisis in her diary and noted the danger that had passed. The word bailout appeared in financial writing for the first time in direct connection with the Baring rescue of 1890. The concept it described, a central bank organizing private institutions to collectively guarantee the debts of a failing systemically important firm, has been the template for every major financial rescue since. The rescue of Baring Brothers contained the crisis in London. It did not contain it everywhere. Argentina itself continued its descent into severe recession. Real GDP fell 11% between 1890 and 1891. The country's leading banks, which had been propped up during the initial crisis, collapsed in 1891 when new loan conditions required the government to stop providing support. Depositors across Argentina lost savings accumulated over decades. The Banco de la Provincia de Buenos Aires, one of the country's most important financial institutions, failed. The paper peso, already depreciated, lost further ground. Gold convertibility was not restored until the early 20th century. The contagion spread beyond Argentina. Sovereign bond prices for Brazil fell 31% in the 2 years following the crisis. Chilean yields rose sharply. In the United States, the Panic of 1890, as it became known, produced a significant stock market decline and contributed to a credit tightening that lasted into 1892. For the ordinary Argentine depositor, the crisis was total. Savings accumulated in the banking system evaporated. Currency that had been trusted became paper that bought less every month. A generation of Argentine savers discovered what every generation of savers in a sovereign debt crisis discovers: that the guarantees given by institutions in good times do not survive the bad ones. And yet, the global trading system held. The grain ships kept moving. The letters of credit kept functioning. The Victorian international economy did not freeze at its critical node. Because one man, working in secret over a single week in November 1890, had understood what was at stake and acted before the market knew there was anything to fear. The Baring crisis of 1890 established 3 principles that have governed every major financial rescue in the century, and a third since. The first principle: a systemically important institution cannot be allowed to fail, regardless of how reckless its management has been. The damage to the broader system will always exceed the moral satisfaction of letting the guilty party collapse. Lidderdale understood this in 1890. Ben Bernanke understood it in 2008. The principle has not changed because the underlying mathematics has not changed. The second principle: the rescue must happen before the public knows there is anything to rescue. A bailout announced before a panic begins can be calibrated and controlled. A bailout announced after a panic has started cannot. The week of silence that Lidderdale maintained between November 8 and November 15 was not deception for its own sake. It was the operational requirement of effective crisis management. The third principle: accountability must be demanded from those whose decisions caused the crisis, but the accountability cannot be so complete that it prevents the rescue. The Baring partners lost their personal fortunes. The firm was restructured and lost its independence. But the business was saved because the alternative, a system-wide collapse, was worse than the injustice of saving people who had caused the problem. 118 years after Lidderdale assembled his rescue fund in secret, Henry Paulson and Ben Bernanke walked into the Senate chamber asking for $700 billion. The structure they proposed, a central authority organizing private and public resources to guarantee the debts of failing systemically important institutions, was the Lidderdale template, rebuilt for a larger system on a larger scale. The crisis of 1890 is not a historical curiosity. It is the founding document of modern financial risk management. And the questions it raised: who gets rescued, who bears the cost, and at what point does protecting the system require letting ordinary depositors bear the consequences, have never been fully answered. They are still being asked. If this account has given you a clearer understanding of how financial power actually operates, subscribe to the channel. There are more crises, more decisions, more turning points still to document. And if this period of history connects to something you lived through, or something a family member witnessed, the bank runs, the inflation, the austerity, the moment a system everyone trusted stopped working, tell us in the comments. What did they see? What did it cost them? What did they believe afterwards? The official version of these events is always written by the institutions that survived them. The fuller version belongs to the people who did not.